Hello, and welcome to my video on the auditing of revenues. This is a very important topic because the majority of financial misstatements and financial reporting frauds involve misstatements of revenues. Okay, so revenues are a very high risk area for auditors. Because of its importance, I'm going to discuss the auditing of revenues over two seminars. There's today's seminar, and then there's also the next seminar. In preparation for today's seminar, you should read through the outline. The objectives of the seminar are, first of all, you should know what are the revenue recognition criteria in SAB 101. What are the 6 common methods that companies use to overstate revenues? We'll discuss the first 3 of those methods in seminar 17, and the other 3 we'll go over in seminar number 18. And the 3 methods that we'll talk about in seminar 17 are involving sales returns and consignment sales, premature revenue recognition, and fictitious sales. Okay, so those are 3 of the 6 areas in which revenue misstatements are likely to occur and therefore pose high risk to an auditor. So in preparation for the seminar, you need to read through the seminar outline, have a look at the questions, and there's also a student presentation. This presentation is about a company called Learnout and Houseby, which was involved in a revenue fraud, and you'll need to read through that case in order to answer a pub quiz that you'll have in class. You'll need to view the video. That's the one I'm recording now. There's a video documentary about a company called ZBest, which was involved in a revenue fraud. That video is 10 minutes. And that video, that fraud involving ZBest actually led to a movie being made in 2018. The movie was called Conman. And I've included a 2-minute video showing you the trailer to that movie. It's a very entertaining movie. If you get a chance to watch it, I would encourage you to do so. It's actually on Amazon Prime. That's where I watched it. There's some recommended reading from the Committee of Sponsoring Organizations of the Treadway Commission. This is a famous report that discusses how companies engage in fraud. And then there's SAB 101, which is the 5th reading here. That's going to be useful for this first learning objective here. What are the revenue recognition criteria in SAB 101? Okay, so the questions to be covered in the seminar, I have one question which is a cutoff test. So a very kind of practical example here where you're given the numbers, the numerical sequence of shipping documents and sales invoices, and you're asked to identify which are recorded in the correct period and to identify what the misstatement is during the year. Okay, so this is a cutoff test. And so this is, first of all, you have to identify what the misstatement is, and then you also have to comment on the following statement from your supervisor who says, it's good to know that sales are now being recorded in the correct accounting period. Right? So after you've made your adjustment, is it necessarily the case that that statement is true? Okay, so do you agree with this comment? So that's question 1. Question 2 is the Learnout and Houseby case. Okay, so for this, there are the following questions. First of all, why did Learnout and Houseby record fictitious sales? Secondly, why did Learnout and Houseby also overstate its cash receipts from accounts receivable? So this was a revenue fraud that also resulted in a fraud involving cash. Thirdly, what substantive tests can auditors use to test the occurrence assertion for sales? And with the benefit of hindsight, which of those substantive tests, if any, would have revealed the fictitious sales at Learnout and Houseby? And then part D is, suppose the auditors had successfully uncovered the fraud, what accounts would have need to be adjusted in order to ensure fair presentation of Learnout and Houseby's financial statements? Okay, for this, you don't need to give precise dollar amounts. You don't have enough information in the question to know what that is, but you should just identify which accounts would need to be adjusted and the direction of the adjustment. Okay, so in other words, what would be the correcting debits and credits to those accounts? All right. Okay, so these are the learning objectives. First of all, I'm going to talk about the revenue recognition criteria in Statement of Accounting Bulletin 101. Then I'll list the 6 common methods that companies use to overstate revenues. And then next, we'll talk about 3 of the methods that companies use, and the other 3 we'll talk about in the next seminar. So we'll go over sales returns and consignment sales, premature revenue recognition, and fictitious sales. Now, I mentioned the COSO report that's on your reading list. It's optional reading if you want to read it. But a basic summary is that it found 50% of SEC enforcement actions. These are actions in which the SEC is alleging that the company engaged in fraud. 50% of those involved fraudulent revenues. Okay, so revenues are misstated in approximately half of accounting frauds. Of those, 26% were fictitious revenues. So the company was claiming to have made sales that it simply never made. And in 24% of cases, the company was prematurely recognizing sales. So in other words, the sales did occur, but the company was recording them in the wrong accounting period. Okay, and that's the motivation for going over question 1. The cutoff test is designed to identify this type of misstatement. Okay, so this is one piece of evidence showing that revenues are a high-risk area. A second, more recent piece of evidence is a report from PricewaterhouseCoopers that found that overstated revenues were cited in 32% of securities litigation cases back in 2011. Okay, so again, it's quite common when there's a lawsuit for the lawsuit to allege that the company was overstating revenues. Now, before going any further, we need to understand what the appropriate accounting is for revenue recognition. And there are 4 essential criteria that are laid out in SAB 101 that have to be met before a public company can recognize revenues. I'm sure you've seen this before, but I'm just putting this here as a reminder. Okay, so first of all, there should be persuasive evidence that an arrangement exists. Okay, so in other words, there is an arrangement between a buyer and seller, right? The buyer has agreed to purchase the goods and the seller is going to deliver the goods. Secondly, there should be evidence that delivery has occurred in the case of a product, or if it's a service, that the service has been rendered to the buyer. Thirdly, there should be evidence that the seller's price is fixed or determinable. Okay, that's important so that the company knows what the amount of the sale is. And then finally, the company's ability to collect payment is reasonably assured. Okay, so the company should be reasonably confident that it can collect payment for the product it's delivered or for the service that is provided to the customer. Okay, so there are 6 common methods that are used to overstate revenues. They're listed here. What I'm going to do in this seminar is go over the first 3: sales returns and consignment sales, premature revenue recognition, and fictitious sales. And then in the next class, I'll talk about 3 more, and that's round tripping, revenues from services, and sales contracts with multiple elements. Okay, so that's where this video finishes. I'll see you in class.